Yo, what up everyone? In this video, I want to talk about some tips to finding consistency in your trading, becoming profitable, and how to grow an account. Whether you have a small account or even a large account, the concepts will apply. I made a video like this in the past, and I'm going to continue making these because I know how much they help others by simply tweaking your trading style just a little bit. We're going to get into these points, but I can't tell you how many members in the community came up to me and told me how their account has grown and how much more consistent they've been by doing what I'm going to explain in this video. Before we get into it though, all I ask is if I provide any value to your trading, if you could just put a thumbs up on this video. And if you haven't already, I recommend following me on Instagram at Entrepreneurship. I post daily trading recaps on here along with very good trading tips and tricks that I guarantee you aren't going to find anywhere else. Link is in the description below. You're missing out if you're not following it. But now, let's get right into the video. Now, this isn't automatically going to make you a profitable trader. You still need to put the work in to get results out of it. But I can guarantee that this is going to speed up the learning curve in order to become consistent and profitable, because a big barrier to profitability is noise in everyone's trading. So the first point I want to make here is I recommend focusing on trading SPY and QQQ, only the S&P 500 and only the NASDAQ. They are the markets themselves. Any other stock, major market leading stock you look to trade, Apple, Amazon, Tesla, Boeing, Facebook, Microsoft, they are components of the market themselves. So when there is volatility in the market, I recommend sticking and focusing on trading SPY and Q specifically. Now, I chart the S&P 500 future, yet I still trade SPY options off of this chart. You could trade the futures. If you were to look at both charts, they're going to be identical. It just works best for me to chart the future, yet trade the option. These charts are identical. So if you can alleviate the noise by scanning for other names, looking for hot movers, biggest gainers, largest downgrades, it's going to eliminate the noise. When you have two specific names in front of you on a daily basis and your sole focus is on the market themselves, it's going to be so much easier to read the context. It's going to be less noisy. It's going to be the easiest to create plans for. I mean, every single day in the Discord, I post plans, and these plans are very clean. They work out very, very well because of less noise in my trading, and I'm solely focused on what the market's going to give me. For example, look at my charts. It's very clean. I consider these naked charts. I have solely price and volume on here. VWAP, volume, supply and demand zones. The market rallied inside of supply, sold off back into demand, where we bounced. Setups like this happen pretty much every day, and when there isn't a setup or when the market really doesn't cooperate very well, it's very evident and it gives us a good signal to maybe sit sidelined. It's the easiest to react to, and it's the most consistent and easiest to adapt to the current conditions. The market we're seeing right now, I actually made a video on this. The market that we're seeing right now, let me make this a blank canvas, with higher volatility is different from what we have been seeing the past few months. And these are the conditions that you can get very large movers in with all this volatility. So when we're switching from balance to imbalance or volatility versus non-volatility, it's very easy to spot it and it's very easy to react to it and adapt to those conditions. Now, because of this, there are less emotions involved. We become less emotionally attached. It's a big mental barrier to get over. I'm sure a lot of you scan for stocks or have 20 other names on your watch list and you chart through them, which is fine. I'm not going to disagree with that. I do that myself. However, sticking to these two names, you know their personalities, you can solely focus on their charts, and you're less emotionally attached. And I can guarantee you 90% of the trades that everyone loses on, including myself, have to do with our emotions versus what we know about the market. Now, ES and NQ, they're very, very liquid. This is probably one of my favorite reasons, or top two reasons why I trade these names, is because how liquid it is. There's essentially a very, very tight spread, and it's very easy to trade. What I mean by this is if we go to the options chain, we look at the contracts. As you could tell, it's obviously Friday as I'm recording this, but the premiums are extremely, extremely cheap. At the money, you're going for 70 cents right now. We also have a 20-cent contract, and the spreads are a penny. At most, you're going to see is 3 pennies, maybe 4 pennies if you're trading liquid contracts at the money or one out of the money. So it's very, very easy for us to buy. It's very easy for us to sell. We do not lose a lot on slippage trading something. For example, QQQ. The spread, the difference between the bid and the ask is about a penny, at most 2 pennies at the money, right? If we go to a name, let's just say Amazon, where it's not extremely, extremely liquid, look at the money. Automatically, we're going to be down 70 cents between the bid and the ask, depending on our order type. So 70-cent spread compared to SPY, which is a penny or 2 pennies difference of a spread. And because of this, they're very liquid. The S&P is probably one of the most liquid markets in the world. NASDAQ is right behind it. Now, because of this and how cheap they are, smaller size yields higher percent gains with less risk. When you're trading Amazon and the spreads are $1, don't get me wrong, I've made a lot of money trading Amazon, Tesla. But when you trade names like that, there is higher risk because of how wide the spreads are and how volatile they are. The S&P and NASDAQ is extremely volatile, but it's in a controlled manner that you could trade smaller size, yet still produce higher percent gains with less risk. There's also 3 expirations per week. We all know what happens on 0 days to expiration or 1 day to expiration when you're trading contracts. It's a beautiful thing right there. And the point I'm going to get into with this video and show you charts to back this up is it works very, very well with supply and demand, price imbalances, due to its highly liquid nature. Every single day this week, there was a very clean setup. I probably had one of my best weeks in a while, probably within the past 2 months this week. I absolutely killed it this week, planned for it. Every single day, the pre-market plan worked out very well. Don't want to gas myself up. Worked out very well. As long as you execute, you react to the market, you adapt to the conditions, you manage your risk, you are going to propel yourself one step forward to finding consistency, and with consistency becomes profitability. So with price and volume analysis, especially supply and demand, the S&P and NASDAQ works extremely, extremely well. There's setups pretty much every day. And if there isn't a setup, it's very easy to avoid, and it's very easy to understand and make it a fact that's known that there is not a setup due to how liquid the market is. To put this into perspective, let's go into the charts. I first want to go into the pre-market plan from Thursday just to get some context from December 9th, 21. So I post these every single day in the Discord, the setups I'm watching, levels I'm looking out for, and areas of interest. We had the NASDAQ, QQQ, we were in balance, and we had 4 different scenarios that we were watching. The first one I want to go over is number 3. We had a balance high at 16,407 and a quarter. And if sellers are responsive, we fail to break out of this, it's going to bring us lower, back into the range, and we are going to test demand lower. So up here in the top right, I have NASDAQ on a 5-minute chart. Here is our 16,407 supply zone. And then on the left, what I'm going to add right here is the QQQ 399 puts. And I'm going to go to a 1-minute chart and remove this theoretical price. So just to look at what this looks like, here we have the QQQ puts. And at the morning open, when NASDAQ came into supply, I'm actually going to synchronize the crosshairs. So at the time NASDAQ was in supply, if you look at the left, the contracts were about $1.64 was the low. The contracts at a high on the puts when we came into demand on NQ was at a high of $3.75. If I were to pull up the spreadsheet I just added here, the QQQ puts a low of $1.64 to a high of $3.75. That is a 130% return from low to high. No one's ever going to get the low, and no one's ever going to sell at the high. I'm just showing what the options did in relationship to the chart. $164 turned into a $211 profit. $1,600 turned into a $2,100 profit. The point I'm trying to make here is you do not need a lot of money to do it, which is why this is very favorable as well for smaller accounts or even larger accounts. These went up 130%. But let's just say we shorted at supply. Maybe we took profits when it came below VWAP. Let's just call it at this high right over here. The contract still went up 68% in a 10-minute period. Very fast moving. These move just like penny stocks. They're very, very liquid, and it works very well with price and volume and supply and demand. Now, let's act like we're playing calls off of this demand zone right here for maybe a quick scalp into VWAP where we sell full position. I'm going to do this. I'm actually going to remove theoretical price and add volume. So now we're looking to play calls off of this demand zone. After NQ hits demand, we're looking to play the QQQ 397 calls. These went from a low of $1.95 to a high, let's just call it VWAP, at $2.95. That is a 51% return in 30 or so minutes. $195 into $100 profit, $1,900 into $1,000 profit. Again, from low to high, but let's just say we catch a quick move. Maybe we bought at $2.10 when it came out of demand, and we sell when we get a quick 20-point rally on that. That's still 20% in 5 minutes. If you're trading, let's just say 100 contracts, you're $20,000 invested into this position, and you're making 20% on a $20,000 investment, you do the math. It's $4,000 in 5 minutes, 10 minutes tops. So I just love how these move, how liquid it is, and just how, I don't know how to explain it, just the personalities of trading NQ and SPY. Another trade on Thursday was NQ from scenario number 2. We're going to test the lower balance, no signs of buying / heavy selling pressure at demand at the 16263 level. I'm going to look to capitalize on puts targeting the demand lower at 16133 and a quarter. So essentially what I mean by this is the first time we tested demand, we had a nice, decent rally to the upside for about 90 points. Now when we come back and don't bounce and test it again, and we do not find the same amount of buyers or the same interest from buyers at that demand zone again, it's very likely, since we have demand a little lower than that, that we could sell off once we get heavy selling pressure below that into the next demand zone lower. So what I did here was loaded up the 395 puts, and at the time we broke on this, let's just say it looked like this, and we're getting ready for about a 70, 80 point drop to the downside. That 70 to 80 point drop was good for 70% in 10 minutes. But let's just say we waited, maybe it started flagging out, and we played a break after this demand zone when it acted as a resistance / we flagged at it, it broke the flag. And let's just say we got short or played puts at 245 when the market was this price. It was at $1.90. By the time we triggered the demand zone lower by end of day, these went to a high of $3, let's just call it, for 59% in a very fast move. And if you look at these options, they really don't get crushed with premium decay, with time decay, with volatility. It was essentially just a straight move up. And those trades, when the market works out in your favor right away and aggressively, those are the best trades. They're stress-free and they're risk-free, and you start playing with house money at that point. And I could go on with 100 different trades that I took, ones that worked out well. That's not the point of this video. But this is an example on SPY today. We sold off aggressively into this demand zone at 4665. And if I were to pull up the SPY 468 contracts, go to a 5-minute chart, these today went from a low at demand at the bottom of 50 cents. So let's just say you buy one contract, it costs you $50. Or you buy 10 contracts, it costs you $500. 10, 20 minutes later, these went from 50 cents to a high of $1.40 for 172% if you sold, let's just say, at VWAP. That's a quick 15 point, 17 point rally from this demand zone. On the chart, it doesn't look like much, but when you compare it to the options, it does. Let's just say conservatively, we got an entry at 70 cents. We played 10 contracts. It cost us 700 bucks. 700 bucks is not a lot of money in this case, right? Our risk is low a day. We're only risking about 20 cents. And our potential reward, let's just say we wanted to sell at supply, is at $1.70. That is a 170% return. And by end of day, these went up to $3 from a 70 cent, 50 cent, let's just even call it. They went up over 260%, even as most as 290%. Very, very clean movements. I'm telling you guys, if you focus, I'm not telling to alleviate, if something's working for you, trading other names, go for it. But for me, if I had to pick two names for the rest of my life to trade, I would trade the S&P and I would trade NASDAQ. It works beautifully with price and volume. If you can learn how to read these two markets, you could make a ton of money only trading those two names. I know somebody that works on Wall Street. I know him personally. He took less than 12 trades last year and made over 10 million. That just goes to show you he only trades the S&P and he only trades oil. So he sticks to his markets he knows and he makes a killing. If you think you got to trade 100 different names, you could make tons of money off it. I'm not going to argue. There's people that kill it with other names. But if you are struggling or if you want to find consistency, I can guarantee you a big roadblock is your emotions. Your trading is causing too much noise. And if you focus on this, I guarantee you, you're going to see a big difference in your trading. It takes time. Don't think you're going to do it tomorrow and you're going to be a millionaire. It takes time. Slowly understand context. Slowly master your emotions. Respect your risk. And trade small size until you develop an edge. If you have a $100,000 account, you shouldn't be going in with all $100,000 for every single trade if you don't have an edge. Trade small until you build your edge up and then scale your trading even further. That's the best part about trading is it's scalable. If I enter with one contract, it's the same thing as entering with 1,000 contracts. The only difference is adding a couple zeros to my order entry. Percent amount is going to be the same. The process is going to be the same. The only thing that's different is how you view it, your emotions, and your perspective on it. So I'm going to leave you all off on that note. If you enjoyed this video, I would appreciate it. Just drop a like, comment if you have any questions. And if you really want to learn more, check out the links in the description below. I offer a very in-depth and educational course that will come with access to the Discord and no extra cost. I will be adding a full tape reading section to the course by year end. Definitely looking forward to it. And yeah, that's it. Peace out.